Hi, I'm Kristen McKenna, President and Wealth Advisor at Darrow Wealth Management. Today, we're going to talk about the three reasons I rarely recommend exercising stock options right before an IPO. Three reasons are cash, IPO performance, and liquidity. So, if you're a pre IPO company, it's probably a buzz. Everyone has the water cooler talk. They're talking about what strategies to do, who to work with, got to exercise now. Don't make any mistake. Exercising at the right time can pay off in the form of generational wealth. But that's not what we're talking about today. So, see our other videos and articles on the best time to exercise stock options. Because today we're only talking about whether or not exercising incentive stock options or non qualified stock options in the lead up to an IPO is worthwhile. So, think the weeks or months ahead of an anticipated IPO. So the tax savings can sound great on paper, but there's a lot of risks, and that's what we're going to talk about. So the first is cash flow. This is really the biggest thing that prevents clients from exercising stock options ahead of an IPO or frankly at any point in time. So if you're an early employee, you probably have a lot of options. They're probably granted to you at a very low strike price if you're really early. So to buy the stock is usually pretty affordable for most people. But the issue is that there's a huge spread between what the stock is currently worth, the 409A, and what your strike price is. So if you have 100,000 stock options at 10 cents strike price, and if the current 409A is $20, well, it's only going to cost you $10,000 to buy the stock, but the taxable spread is almost 2 million. If you are a more recent hire, you probably have a lot less stock options and it's going to be at a much higher strike price. So you may have 25,000 vested options in this example, but your strike price could be $18 a share. So that would cost $450,000 to buy the stock. So even if the 409A is only $20, your taxable spread is 50, but again, it's the purchase price in this reverse scenario that can be extremely prohibitive for people. Now, again, the tax can come in two different forms. We'll talk about that in many of my other videos and articles, but it is something to be aware of as we get into the third reason, which is liquidity. So the second reason that we typically don't recommend exercising in the lead up before an IPO is performance. And unfortunately, the reality is there's been research done mostly by Jay Ritter on IPOs. And unfortunately, IPOs historically have underperformed similarly sized by market cap companies in their first 5 years by 3.6%. This trend is also true in the first year. So the first 6 months, the underperformance is usually more muted, 0.3%. But over the next 6 months, so months 6 through 12, usually when that lockup has come up and people can start trading, that underperformance gap widens to 5.6%. So you could really be in a nightmare scenario by owing tax at the higher paper price when your actual shares are worth much less when you have to pay the tax, which leads into the third issue, liquidity. So there's a few different liquidity layers of problems here. The first is the lockup period. So it's usually 180 days. That's for current and former employees in most cases. If you're a current employee, there'll be additional blackout periods around earnings releases and trading windows. So the period could really be longer. And it's important what time of year the IPO happens, when the lockup gets released, and when you can actually trade. And all of these things are unknown. Perhaps you are a high ranking senior officer at the company and you have material non public information and you can't trade when everybody else can. The lockup could also have different rules. Companies have their own trading policies too, and that is not going to be known even after the company goes public for a while, much closer to when you can trade. You may need to get pre-approval if you're a current employee to sell the shares. So it might not be enough to cover any tax bill. And again, these are just some of the issues, as well as how long is your window? It could only be a day or two. And then, of course, again, the stock could be down massively, leading you to end up needing to sell a lot more shares than you anticipated. The other issue with liquidity is the IPO might never happen or it could just be delayed, and that could cause a lot of liquidity problems. The last few years, we've seen this time and time again. Chime's IPO was delayed a few years. Stripe is still in a multi-year holding period. Instacart was delayed for a year. WeWork, the list goes on, and those are just some of the more notable names. Personally, we have a lot of clients that have still had IPO plans on the shelf from 2022. So if you're trying to game this out in terms of figuring out the IPO date and the lockup and when the taxes are going to be due with liquidity, it is a really big risk and a gamble to exercise right ahead of the IPO when valuations are typically at their highest. So for these three key reasons, we rarely recommend exercising ISOs and non-quals in the weeks and months leading up to an IPO. There certainly are times where it does make sense, but you just have to consider the full set of circumstances for your situation. As a sudden wealth advisor specializing in stock options and equity compensation, we help clients with these types of issues regularly. So if you're expecting a multi-million dollar liquidity event and are looking to develop a relationship with a wealth advisor to have a long-term partnership to help you to and through this type of liquidity event, please visit our website to learn more and to book a phone consultation.